Turn on any financial media and you'll hear the same story. The economy is resilient. We've achieved a soft landing. Everything is going to be fine. Stocks are rising, unemployment is relatively low, and central banks are pivoting to rate cuts. So how come growth forecasts are being slashed? Debt is reaching record heights, and the World Bank says that we're heading for the weakest economy performance since 2008. What's the truth? Are we on the brink of a boom or sleepwalking into a recession? The answer could be the difference between your portfolio thriving or dropping dead. My name is Lewis, and you're watching The Coin Bureau. First things first, nothing in this video is financial advice. I'm just asking why every green shoot of recovery seems to wither on closer inspection. If you want to keep getting the unvarnished truth about what's really happening in the economy and the markets, smash that like button, subscribe, and ring that notification bell. Now, in July, the IMF's chief economist said the global economy is on its, quote, final descent towards a soft landing. Meanwhile, megabank JP Morgan keeps pointing to the, quote, decent amount of resilience in both the US and global economies. Stock markets are buoyant, headline unemployment is low, and after a brutal rate hiking cycle, central banks are finally turning to cuts. Every financial headline is singing from the same hymn sheet. But scratch beneath the surface and the data underneath tells a rather different story. The IMF's latest forecast has global growth at 3.0% for 2025. Sounds decent until you notice that it's well below the historical average of 3.7%. And their 5-year outlook is the weakest in decades. The World Bank has been more direct in their pessimism. They've cut their 2025 global growth forecast to just 2.3%. If that materializes, it'll be the slowest growth since the global financial crisis of 2008. They've downgraded nearly 70% of all economies since the start of the year, which sounds more like a massacre than a revision. The OECD, on the other hand, has walked the middle ground, projecting 2.9% global growth for this year. But they're explicit about why it's still below the average. Quote, substantial increases in trade barriers, tighter financial conditions, weakened businesses, and consumer confidence. Meanwhile, the language of recovery and resilience, or a soft landing, is fading from view. And that's because what the resilience politicians are celebrating is borrowed from the future. Companies have been front-loading imports ahead of tariffs, pulling demand forward. Governments have been running massive fiscal deficits, creating artificial growth. It's like celebrating your wealth after maxing out your credit cards. And speaking of tariffs, Yale's Budget Lab calculates the 2025 US tariff package will raise domestic prices by 2.3% while cutting growth by up to 0.9 percentage points. That's a textbook stagflationary shock. Higher prices, lower growth. Exactly what nobody needs right now. And if you want to find out just how messy global inflation and deflation have become, you can check out our video on that, linked down below. But here's what you need to know for now. JP Morgan forecasts global core inflation will actually increase to 3.4% annualized in the second half of 2025. Not decrease, increase, courtesy of US tariffs. This creates a nightmare scenario for central banks. The Fed was supposed to be cutting rates by now. Even though many now expect cuts in September, some analysts think that we won't see cuts until 2026. The higher for longer narrative is morphing into higher forever. Meanwhile, the European Central Bank has already started cutting rates because European growth is anemic and inflation is cooperating. As we've noted in our video about global inflation, this divergence between central banks is unprecedented in the modern era. We've gone from decades of synchronized global policy to every central bank for themselves. The problem is that tariff-driven inflation isn't like pandemic inflation. You can't fix it by raising interest rates because it's not caused by excess demand. It's a supply shock, and fighting supply shocks with monetary policy is like trying to fix a broken leg with chemotherapy. But back to the economy. The US economy does look strong on paper. Corporate earnings are growing at 8.5%. The unemployment rate is still just 4.2%. Consumer spending remains robust. America seems to be defying gravity while everyone else crashes back to earth. But this strength is increasingly hollow. Job creation has slowed dramatically. The US is adding about half the jobs that it was a year ago. And dig into July's employment report, and you'll find the economy actually lost 440,000 full-time jobs. That ugly fact was papered over by a rise in part-time work. When full-time employment starts shifting to part-time, that's your canary in the coal mine. Meanwhile, those robust consumers holding the US economy on their backs just happen to be drowning in debt. Total US household debt has hit a record $18.39 trillion. Credit card balances alone have soared past $1.2 trillion, with delinquencies climbing fast. That kind of consumption data smells more like desperation than confidence. People spending on credit, trying to keep their heads above the water. Not only that, but the Conference Board's leading economic index, which has predicted almost every US recession since 1970, keeps slipping lower, signaling weakness ahead. More importantly, US exceptionalism is creating its own problems. Strong demand plus protectionist policies equals sustained inflation. The Fed can't ease without risking an inflation resurgence. It's trapped between supporting growth and controlling prices. The S&P Global PMI data tells the real story, though. While the composite index hit an 8-month high in August 2025, that strength is entirely in services. Manufacturing PMI remains in contraction territory. That's not a healthy economy. It's a bifurcated one, where domestic services thrive while globally exposed manufacturing withers away. Consensus forecasts for US growth in 2025 cluster around 1.4 to 1.6%, down from over 2% in 2024. That's not quite a recession, but it's perilously close to stall speed. And it wouldn't take much to bring the economy to a full stop. Now, if America is running too hot, Europe is barely running at all. The Eurozone is limping along in economic purgatory at 0.9 to 1.3% growth for 2025. These problems are structural, so they won't be fixed by tinkering around the edges. Take Germany, Western Europe's industrial engine. It's getting slaughtered by Chinese competition on one side and US protectionism on the other. Germany's car industry is supposed to be its own crown jewel, but between China's EV supremacy and Trump's tariffs, the outlook for Volkswagen and the gang is looking pretty bleak. The EU's own analysis shows how exposed they are to China's economy. When China is cranking out cheap exports, European manufacturers can't compete. But when China's economy slows, European exporters lose their biggest customer. Heads they lose, tails they lose. The ECB is trying to help with rate cuts, but fiddling around with interest rates can't save Europe from energy insecurity, nor its widening tech gap with the US and China. So they're following the orthodox playbook: fiscal consolidation, gradual monetary easing, structural reforms. It's sensible, prudent, and basically guaranteed to deliver years of subpar growth. Europe is choosing stability over dynamism, and the price is economic relevance. Meanwhile, China is officially targeting, quote, around 5% growth for 2025. But the quality of that growth is questionable, to say the least. Vanguard expects China's core inflation to be near zero in 2025, which is way past price stability and knocking on the door of deflation. At the same time, the property crisis that started in 2021 has morphed into something much worse. Property prices have fallen 15 to 30% depending on the city. Household wealth has been decimated, local government finances are a mess, and the screws of China's economic miracle have come loose remarkably quickly. Beijing's response has been to double down on the same strategy that created the problem: more investments, more industrial capacity, and more exports. They're channeling credit to state-owned enterprises to build factories for electric vehicles, solar panels, and batteries. But domestic demand is too weak to absorb this production, and foreign markets are putting up trade barriers to protect their domestic industries. The Fed's own economists question whether China is even growing at 5%. Alternative indicators suggest something closer to 2 to 3% is more realistic. If the world's second largest economy is potentially overstating growth by half, that's kind of a problem for everyone. And the parallels with Japan's lost decade are impossible to ignore. Real estate bubble? Check. Excessive investments? Check. Weak consumption? Check. Demographic cliff? Check. The difference is that China's imbalances are even more extreme than Japan's were in the 1990s. And this begs the question of what's been going on with the rest of the world. Well, the emerging markets story used to be simple. China drives commodity demand, commodities drive emerging markets. But that equation is broken. Growth is slowing from 4.3% down to as low as 3.7% in 2025, with massive regional divergence. India remains one of the very few bright spots, though, growing at 5.6 to 6.2%, powered by domestic demand and favorable demographics. They're the only major economy with high growth that actually looks sustainable. On the other hand, East Asia, excluding China and India, faces a brutal adjustment. They're caught between slowing China and rising protectionism. Countries like Vietnam and Thailand that rode the globalization wave are discovering that the wave has crested. Latin America is continuing its tradition of tepid growth, 2.3% to 2.5% for 2025. They're vulnerable to commodity price swings and higher US rates, meaning that every Fed meeting is a potential crisis for their currency and debt markets. Africa might accelerate to 3.7 to 4.1%, but from a low base, and they need growth rates double that just to keep pace with population growth, all while many African countries are already in debt distress. This begs the bigger question, and that's what the economic picture looks like when you put all of these pieces together. According to a survey by the World Economic Forum, 94% of chief economists expect further trade fragmentation. Although frankly, you don't need an economist to tell you that deglobalization is in full swing and taking its toll. For manufacturers, the recession is already here. The JP Morgan Global Manufacturing PMI has been in or near contraction for months, with new export orders especially weak. Then there's the debt bomb. The Institute of International Finance reports global debt hit $324 trillion in Q1 2025. That's a new record, and it's growing faster than GDP. It might have been manageable at zero rates, but at 4 to 5%, we're in emergency territory. The OECD calculates that 45% of sovereign debt and 1/3 of corporate bonds mature by 2027, meaning that they'll have to be refinanced at much higher rates. But government interest payments are already exceeding defense spending. This is how debt crises begin. The interconnections make everything worse. Trade war causes inflation. Inflation keeps rates high. High rates stress debt. Debt stress causes financial instability. Financial instability triggers recession. It's a doom loop waiting for activation. Insurance firms like Spanish giant Mafre have been laying out the major risks on the horizon, from AI disruptions to environmental disasters. The bigger picture here is that these could easily cascade into so-called Omnicrises. For example, a wider Middle East conflict could spike oil prices. Higher oil prices could worsen inflation. Worse inflation could mean higher interest rates. Higher interest rates stress the debt mountain. Debt stress triggers defaults. Defaults cause a financial crisis. Crisis leads to recession. This domino effect is characteristic of every crisis since the 1970s. Political risk is a big one too. We've all seen the White House trying to wrest control of the Federal Reserve from its governors. But when politicians pressure central banks during inflation, you risk undoing the lessons of the 1970s. When they pressure them during debt crises, you get Argentina. Neither ends well. Meanwhile, spiraling environmental crises are turning out to be very expensive. Droughts destroy crops, floods wreck supply chains, hurricanes devastate infrastructure, and so on and so forth. Insurance companies have had it up to here, and they're starting to abandon vulnerable regions. That's bad news for the economies that they leave behind, because when risk becomes uninsurable, economic activity grinds to a halt. So, what are the markets making of this economic outlook? In case it wasn't clear enough, stock markets are still priced for perfection, not reality, with the S&P 500 in euphoric, if not manic territory. The correlation between GDP and stocks during downturns tends to be weak initially, and markets often bottom before recessions end. But the initial drop can be savage, like in 2008, when stocks saw a 57% peak-to-trough decline. Bond markets are no safe haven either. Yes, government bonds rally in recessions as rates fall, but we might not get rate cuts if inflation stays elevated. The traditional 60-40 portfolio assumes bonds zig when stocks zag. In a stagflationary scenario, both tank together. Commodities face a brutal split. Industrial metals and energy crash when demand dries up. Agricultural commodities might hold up better, especially if supply shocks continue. Gold depends entirely on whether fear trumps higher real rates and how much investors have levered up their gold holdings going into a short-term price pullback. Deutsche Bank Wealth Management captured it perfectly. We're, quote, deeply invested in growth that isn't materializing. Markets are positioned for a boom while the economy is wheezing. As we all know, though, recessions are rarely predicted accurately because they're usually caused by something breaking. In 2007, it was subprime mortgages. In 2020, it was a pandemic. The next trigger is hiding in plain sight. We just don't know which one it is yet. It could be commercial real estate, where vacancy rates are hitting record highs and refinancing is becoming impossible. Or maybe a sovereign debt crisis when a major country can't roll over its debt. Perhaps a geopolitical shock that spikes energy prices. Could be all three at once. Frankly, commercial real estate is looking like a good candidate. U.S. office vacancy rates are pushing 20%, with markets like Austin and Seattle hitting 27%. Nearly $1 trillion in commercial real estate loans mature in 2025, and most of these half-empty buildings can't be refinanced at today's rates. The banking system is sitting on a time bomb. The Federal Reserve's own history of the Great Recession notes that financial crises follow periods of excessive debt accumulation and asset price inflation. Check and check. They also note that policy responses are constrained when crises hit during inflationary periods. Also check. What's different this time, though, is that we're fragmenting while facing these challenges. During 2008, central banks coordinated. During the pandemic, governments synchronized stimulus. Next time, it'll be every country for itself. And this brings me to the biggest question of all. Is the global economy heading for a boom or a recession? Well, the answer seems to be neither. We're heading for something potentially worse, a prolonged period of stagflation light where growth disappoints, inflation persists, and traditional investment strategies fail. The mainstream resilient economy narrative is technically true, but deeply misleading. Yes, we're avoiding immediate recession, but resilience bought with unsustainable debt and artificial stimulus is just borrowed time. The IMF calls this moment a, quote, critical juncture amid policy shifts, which is policy wonk speak for stuff's about to get weird. The three-speed world, America overheating, Europe stagnating, and China deflating, can't continue indefinitely. Something has to give. For investors, this means accepting that the easy money era is over. You can't just buy the index and expect 10% annual returns anymore. You need to be selective, defensive, and ready for volatility that will make 2022 look like a snooze fest. For crypto, this environment might be bullish because the traditional financial system is revealing its fragility. You know the spiel. When sovereign debt becomes questionable, fiat currencies volatile, and conventional assets correlated, the case for alternative stores of value strengthens. Bitcoin doesn't flinch at trade wars or central bank divergence. As you might have noticed, the path forward depends on political choices more than economic fundamentals. If trade wars escalate, recession becomes likely. If they stabilize, we probably keep things ticking along. If by some miracle they reverse, we might actually get that boom everyone is hoping for. But the structural forces, demographics, debt, deglobalization, they aren't reversing anytime soon. The synchronized global economy of the early 21st century is history. We're entering an era of permanent fragmentation where every country follows its own path and traditional correlations break down. It's not the end of the world, but it probably is the end of easy assumptions about perpetual growth. The countries and investors who adapt fastest to this new reality will thrive. Those still operating on the old playbook will get left behind. You have been warned. Anyway, if you think that's bad, wait till you hear about the demographic time bomb ticking underneath all of this. Turns out it doesn't matter how much debt we rack up, because there aren't enough children to pay it off anyway. You can find out what happens when the pension Ponzi runs out of players right over here. And as always, thank you for watching. I'll see you next time. It's Lewis, over and out.